Let's bring in Erin Browne now of PIMCO, get her playbook, what that firm is thinking about right now. It's nice to see you. Welcome back.
Thank you.
I think the last time you were on, you were pretty bullish. Do you remain so?
I do. I mean, I think, like the panelists before me just stated, I do think that we're still in a cyclical recovery in the U.S. economy in particular, to some extent the global economy as well, all of which is underpinning a really robust earnings environment for stocks. And I do think that ultimately that's going to be what drives stocks higher from here. I do think, though, that the last two trading days did underscore 2 points which are important. First, rates are moving higher. We've seen a 45 basis point backup in the 10-year yield over the last month or so. And so what that does is, those who were, calling for getting back into laggards, buying the small caps over large caps and a real rotation in the market, I think are likely going to be disappointed. They certainly have been disappointed over the last couple of weeks. And I think that's likely here to stay. The Fed, I think, is likely not going to cut rates until the back half of this year. And I would take the under in terms of what the market's pricing in currently. And what that means is that small caps and those companies that are really leveraged to easy credit are likely going to be disappointed. I think the second point is that you are starting to see a broadening out of participation in the leaderboard for the equity market. And I think particularly for more industrial cyclical economies that have some leverage to inflation, I think that that's, a really interesting spot for the market right now.
Okay, so what I hear you saying is that you can still be bullish, but you just can't express it perhaps as broadly as you once thought you might be able to do.
Well, I think that you can start to express it more broadly across cyclical parts of the economy, but you want to stay large, you want to stay liquid, you want to stay up in quality, and really avoid the smaller cap laggards that have underperformed, certainly over the last year or so.
So you mean the broadening story can continue, just not with the Russell participating?
Exactly. Not with the Russell, not with certain segments of the market, but I do think you want to start expanding your exposure to industrials, to metals, to some extent energy, if you haven't already, that are going to be advantaged by the manufacturing cyclical uptick that we're starting to see, not just here in the U.S., but also on a global basis. So last year, you really...
No, I'm sorry. Finish your thought, Erin. I apologize.
No, I was just going to say, over the last year, you really just wanted to be in tech and tech only. Now you can start to expand that lens outward, but really focusing on the large caps.
I mean, I was just going to say, even with energy and materials already up, quite a lot, that trade has worked in large part on just the whole story coming into focus. Now, if we're rethinking things, have those kinds of stocks moved too fast?
Well, I think there's two things. First, you're seeing inflation tick up on the U.S. Second, you're seeing manufacturing surveys also tick up in the U.S., but also globally. And then you really haven't seen any participation from the global stage in terms of commodity demand, particularly out of China over the last year or so. And you're now starting to see slowly that begin to turn as well. So I think that trade does have legs over the medium term.
Yeah, and so, Erin, I would just add to your point, something that I've been discussing with Scott as well. I would largely just want to echo what you were saying, which is this narrative that in order for the rally to broaden, it's got to be exposed or expressed in the Russell 2000 is an idea with which I totally disagree. And you see it sectorally within the S&P 500 and certainly in the mid-cap space as well. And there's no better example, as you mentioned and Scott alluded to, which is energy, a name that lagged for quite some period of time. Big cap tech is obviously running into trouble now, but when you look at the refiners, you look at some of the integrateds, even some of the other riskier sectors, energy's done incredibly well. And again, if you're looking for evidence of broadening, why isn't energy, and I'm not saying you said this, but why isn't energy a sufficient evidence for that broadening?
Yeah, so I would absolutely agree with that. I'm still keeping long my large cap tech names. I still like the AI trade. I still like things that are levered to large cap tech, but not selling that portion. But where I'm buying right now is more on the sort of industrial cyclical sectors.